OG Anna AG here. Yes, John AG's sister. Same mission, same values, different voice. This channel exists for one reason: financial education and independent thinking. I don't sell courses. I don't run signals. I don't manage your money. I never will. What I do is help you understand what the markets are actually saying so you can think for yourself. Let's get into it. Something is building in silver, not hype, not a prediction. A structural pattern visible in the data that most retail traders are completely missing right now. COMEX warehouse numbers are shifting. The FOMC minutes just dropped language that the mainstream media summarized in about 40 words. And silver, quietly, patiently, is sitting at a technical level that has historically preceded some of the most violent moves this metal has ever made. 9 days. That's the window the data is pointing to, not a guarantee, not a signal, a convergence. And today I'm going to walk you through exactly what that convergence looks like, and more importantly, how to think about it. Stay with me. This is going to be worth your full attention. Let's start with what happened recently and why most people read it completely wrong. Silver pulled back. And the moment it did, social media filled up with two camps. One side screaming that silver is dead, the other side screaming that the manipulation is complete and the moon is next week. Both camps missed the real story. Here's what actually happened. The dollar had a short-term relief bounce. Treasury yields ticked up on hawkish language embedded in Fed communication. Risk assets broadly softened. And silver, which trades at the intersection of monetary metal and industrial commodity, responded exactly the way you'd expect under those conditions. This wasn't a collapse. This wasn't a breakout failure. This was the market doing what markets do, shaking out the impatient money before the next directional move. The question isn't whether silver went down. The question is, what did the structure underneath that move actually look like? And that's where it gets interesting. The chart is telling a story, and stories in markets have characters. In silver's current story, the characters are the COMEX registered inventory, the managed money positioning data from the COT report, and the institutional footprint showing up in options markets. Let me walk you through each one. First, COMEX registered inventory. Registered silver is the metal that is immediately available for delivery. It's the real physical supply backing paper contracts. Over the past several weeks, registered inventory has been in a pattern of steady drawdown. Not dramatic, not the kind of number that makes headlines, but consistent, persistent. The kind of movement that tells you someone, somewhere, is pulling physical metal out of the system. Now, why does that matter? Because the paper to physical ratio in silver is historically extreme. When physical inventory tightens while paper volume remains elevated, you create the conditions for pricing stress. Not overnight, not in a straight line, but structurally, the foundation shifts. Second on the COT data, the commitment of traders report. Here's what most people missed in the most recent positioning data. Managed money, that's the large speculative funds, have been reducing their net long exposure heading into the recent pullback. In normal market language, that means the hot money was getting out. The momentum chasers were stepping aside. Historically, when managed money longs compress to certain levels, while commercial positioning, the miners, the hedgers, the physical users, remains relatively stable, you often see the setup for a repricing event. I'm not telling you a repricing is guaranteed. I'm telling you the architecture of that possibility is present in the data right now. Third, the institutional footprint. Options markets in silver have seen unusual activity in specific strike clusters. I won't go into the exact levels because this isn't a trading signal, and I will never give you trading signals. But the pattern of where protective positioning is being placed tells a story about where sophisticated participants see meaningful risk. And that story is not bearish at current price levels. The chart is showing consolidation with volume characteristics that historically precede expansion. The market is coiling. and coils eventually release. I need to stop here for a moment. And I need to be direct with you. There are people online right now using market analysis language, using charts, using exactly the kind of educational framing I just used, and they're doing it to sell you something: a group, a signal service, a mentorship program, a course that will unlock the secrets of silver. I am not that. I have never asked a single viewer for money. I run no paid groups. I have no VIP tier. I sell no courses, no signals, no subscriptions, nothing. Everything I share here is purely educational. And I will always tell you, verify everything yourself. Don't take my word for it. Don't take anyone's word for it. Go look at the COMEX data yourself. Go read the FOMC minutes yourself. Develop your own analytical framework. The goal of this channel is to make you more independent, not more dependent on me or anyone else. If someone is promising you profits, guaranteed calls, or insider level signals, that is not education. That is exploitation. And you deserve better than that. Now, let me teach you something more valuable than any price target. Let me teach you how to think about markets like silver. The first principle: respect risk before you ever think about reward. Silver is a volatile asset. Historically, it can move 10, 15, 20% in a matter of days in either direction. Anyone who frames silver to you purely through the lens of upside AI, without equally respecting the downside, is either uninformed or selling something. Risk is not the enemy of opportunity. Risk management is what keeps you alive long enough to be right. The second principle: patience is a structural advantage. Most retail participants lose money in markets not because they're wrong about direction, but because they're wrong about timing. They're right about the thesis and wrong about the time frame. The market exhausts them before it proves them correct. Understanding market structure, understanding positioning cycles, understanding the relationship between paper and physical, these tools don't guarantee you're right, but they help you stay calibrated when the market moves against you temporarily. The third principle: independent analysis protects you. When you develop your own analytical framework, when you learn to read GIOT data, when you learn to track COMEX inventories, when you understand how FOMC language transmits into asset prices, you stop being reactive. You stop panic selling pullbacks. You stop FOMO buying tops. You develop a relationship with the market that is grounded in knowledge, not emotion. That's the real edge, and it's available to anyone willing to put in the work. Now let's zoom out, because silver doesn't exist in a vacuum. Silver is connected to a global system, and right now, that system is under pressures that most people don't fully appreciate. Start with gold. Gold has been signaling something for months. Central bank purchasing, particularly from emerging market central banks in Asia, the Middle East, and Eastern Europe, has been running at historically elevated levels. These aren't momentum traders. These are sovereign institutions making multi-year strategic decisions. And they are choosing gold over dollar reserves at a rate not seen since the Bretton Woods era breakdown. When gold moves, when it moves on institutional, sovereign-level demand, silver historically follows. Not immediately, not in a straight line, but the gravitational relationship between these two metals is real and documented across decades of price history. Now layer in inflation. The mainstream narrative has repeatedly declared inflation defeated. But the structure of inflation, sticky services, elevated shelter costs, energy supply constraints, suggests the story is more complex than a simple headline CPI number. If inflation proves stickier than the Fed's models predict, the rate cut cycle they've been signaling gets compressed. And if the rate cut cycle gets compressed or delayed further, real rates remain elevated, creating continued pressure on growth assets while monetary metals oscillate around critical levels. Now layer in debt. Global sovereign debt is at generational highs. The United States, Japan, the Eurozone, The mathematics of debt service at current interest rate levels is unsustainable across most major economies. This is not a political statement. This is arithmetic. And historically, when governments face unsustainable debt trajectories, the long-term outcome involves some combination of financial repression, currency devaluation, or inflation tolerance. All three of those outcomes historically have been positive structural environments for precious metals. And then there's the geopolitical dimension. De-dollarization is not a conspiracy theory. It is a documented policy trend across a growing coalition of countries. The share of global trade settled in dollars, while still dominant, has been in structural decline. As alternative settlement mechanisms develop, the dollar's structural bid weakens over time. And as the dollar's structural bid weakens, the case for hard assets, gold, silver, real commodities, strengthens. This is the macro ocean that silver is swimming in right now. Now, I have to give you both sides because intellectual honesty demands it. The bullish case for silver in this environment is clear. Physical tightness, institutional positioning setup, macro tailwinds, monetary metal demand, industrial demand from solar, EVs, semiconductors growing structurally. The narrative has genuine fundamental support, but the bearish risks are real too. If the Federal Reserve is forced to maintain restrictive policy longer than the market expects, if a genuine global growth slowdown emerges, industrial demand for silver could contract meaningfully. Silver's dual nature as both monetary metal and industrial commodity means it can trade like a risk asset in risk-off environments, regardless of the macro story. If the dollar stages a genuine strength cycle, driven by capital flight into U.S. assets in a global risk-off event, silver could see significant downside pressure even as the long-term thesis remains intact. And timing is always uncertain. Markets can remain irrational longer than any analysis anticipates. I'm not here to tell you which scenario plays out. I'm here to help you understand both so that whatever happens, you've thought it through before the market forces you to react. I want to hear from you. When you look at silver right now, when you look at the COMEX data, the macro environment, the FOMC positioning, what is your analytical read? Are you seeing the same structural setup I've described? Are you seeing something different? Are you skeptical of the entire precious metals thesis in the current environment? Drop your thinking in the comments, not your emotions, your thinking. Tell me what data you're looking at. Tell me what your framework says. This community grows when we think together, critically, independently, honestly. And if there's a specific market, a specific data point, or a specific macro concept you want me to break down on this channel, tell me. This channel exists to serve your financial education. Help me build it the right way. 9 days, that's the convergence window the data is pointing to, not a prediction. A structural observation built from real data, COMEX inventories, COT positioning, FOMC language, macro currents, all arriving at the same moment in time. Whether silver breaks upward, breaks downward, or continues to consolidate, the most important thing is that you understand why, that you've thought it through, that you're not reacting to price, you're reading the story the market is telling. Markets reward the prepared. They punish the reactive. And the difference between those two categories is almost always knowledge, patience, and the discipline to think independently when everyone around you is governed by emotion. Do your own research, respect your own risk, trust your own mind. This has been OG Anna AG. And remember, the most powerful financial tool you will ever own is a mind that no one can sell anything to.